It's interesting how people have finally started to notice that the Fed balance sheet reduction may have something to do with the recent volatility or the recent declines in the market. This is something I think we've been talking about for pretty much since it started, is that, remember, the Fed is a headwind at this point, not a tailwind. You don't have the Fed increasing a balance sheet. And what that means is, as stuff, it's very technical how the Fed puts money into the marketplace, but let's just simplify it and say, when the Fed buys assets, they pay dollars for those assets. So those assets get out into the financial system. On the flip side, as those assets, which are typically bonds, mature, they receive money, thus taking the money out of the financial system. For a while, they were increasing their purchases, thus putting money into the financial system, or at least they were maintaining them. As stuff would roll off, they'd buy something new. Now, as of the beginning of 2018, late 17, early 18, they've signaled that they're going to let stuff roll off the balance sheet. And so that means money is leaving the system. Most people are not old enough to remember this, but basically, when I started in the business, it was the tail end of the monetary obsession. Everybody was looking at M2, M3, and those numbers would come out at, I think it was a Thursday afternoon, and the market would stop. You know, it was after the close, but everybody would stop and wait for those numbers to hit. And that would tell you what the Fed was up to. Somehow over time that's been lost, but the concept still remains. And the Fed balance sheet got a lot of play. It started to get talked about as an explanatory factor for one of the reasons why we sold off in most risk assets in December. So I actually started to look at the correlation over the past year, because that's really the time frame that we have in terms of the Fed balance sheet contracting. And surprisingly, I could come up with no correlation. The reason for that is there were periods, mostly through the summer, where the equity markets rose as the Fed was continuing to reduce their balance sheet. I tried to look at it, does it happen on a weekly basis? I found no correlation. And only in December did people say, see, the Fed really was reducing its balance sheet. That's the explanation. And that actually in many ways was probably a factor for the sell-off that we saw in February. That was the first of the real big runoffs of the balance sheet. So what's the takeaway? What it means is I think this remains a headwind, but it's not necessarily a tradable piece of news. In light of what people saw in December, I've started to see calls for people noticing that the balance sheet's going to run down a bit on January 31st into February 1st, a bit more on February 20th. This stuff is all available out there if you dig for it, as potentially contributory factors for why the market will fall. All things being equal, this is not a market-friendly event, but I would not strictly trade too much around this. I would say that if the markets are feeling susceptible, this won't help. If the markets are feeling sanguine and bullish, they can pretty much overlook this, at least for short to medium periods of time. So that's my takeaway from the talk that we're seeing and hearing about the Fed balance sheet reductions. I wish I could hand you a smoking gun and say, yes, there's an 82% correlation. I looked, I tried, I couldn't. So just know it's there. Know that when the markets are not performing well, it will be considered an excuse. And if the markets are performing well, it'll just sort of fade into the background. Thanks.